last of this year's episodes in the series of the Eide Bailey Legislative Update. My name is Mel Schwartz. Jay Heflin is joining me. Jay is on site near the Capitol, Washington, D.C., and hopefully maybe has learned a few things today that he can share with all of us. Where we start today is, welcome to the lame duck session 2022 of the United States Congress. And Jay, how are they doing? Is it lame? Are they moving? What's the prognosis here?
Well, maybe we should talk first of all, if someone doesn't know what lame duck means, basically what happens after the election, lawmakers come back and some of them are going to retire. So whatever happens in this session between post-election and the beginning of the next Congress, these guys have no flight, so to speak, no power to actually care about what legislation happened. So the reason why the lame duck is so interesting sometimes is that you have a lawmaker who might have really abided by the party rule, and now they're retiring. They're like, I'm going to vote the way I want to. And so what happens during the lame duck is you might have something happen that wouldn't have happened before the election, because these people essentially are very free. And now they can say, well, let me just vote how I really want to vote, which is a sad commentary on our lawmakers. But this is why the lame duck is such a big deal. And the picture we're seeing there is pretty much what's happening right now. The clock is ticking, and basically everyone says year end. What they really have is until January 3rd. And what they do, what they must do, is they have to fund the federal government beyond the end of the year, and they have to authorize money for the Defense Department. Now, currently, the government is going to run out of funding on tomorrow, December 16th. The House has actually passed a legislation that would extend that funding into January 23rd. Now, this bill only extends the funding and only extends it at the current level that they're getting. So basically, for argument's sake, just to simplify, if an agency got $1 last week, they're going to get $1 next week. Now, if there was another bill, they might have gotten more money, but we'll talk about that later. The other thing we have to do is, I'm sorry, Mel, you gonna say something?
Glenn, I was just questioning. Want to make sure that we've got the dates right here. The extension is to December 23rd, correct? A week from tomorrow.
Yes, but currently it hasn't passed Congress yet, and Biden hasn't signed it into law. So the House has passed it. So technically, the government will shut down tomorrow at midnight if the Senate doesn't pass the bill and if President Biden doesn't sign it into law. So it's not expected to fail.
Good. Okay.
All right. And so with the National Defense Bill, this bill basically authorizes the money for the Defense Department, basically, i.e., it directs the money on how whatever money that they get, the Defense Department, how should they actually fund it, or how should they spend it? And this bill has passed Congress for, I think, something like 60 years. And so there is great emphasis on this bill passing, as much as, even though it's not really an actual must-pass bill, it's considered a must-pass bill because it's passed for 6 decades. Now, these two pieces of legislation are basically the only bills that Congress is expected to pass before January 3rd. And so if there's going to be a tax bill that passes Congress, it's going to be either on the spending bill or on the defense bill. Now, the House has already passed the defense bill, and there's no provisions on there. The Senate is actually going to try to amend that bill. They are going to try to add a permitting amendment to it, which basically would mean that if there's permitting for renewable fuels, then there should be equal permitting for oil and gas. They're also going to try to add to the bill a exemption. So basically, if a military person didn't get a COVID vaccine, They don't have to quit the military. They can still stay in the military. Now, those two changes would, if they pass Congress and if they get added to the bill, I'm sorry, if they pass the Senate and if they get added to the bill, that would have to go back to the House. And once that happens, the House could also make changes. You can play ping pong. It's called playing ping pong back and forth to where you amend a budget back and forth. Now, that's not expected to happen here simply because everybody wants to go home. And so chances are, if the Senate does amend the bill successfully, the House will probably accept what it does, and then it goes to the president for the signature. As for the funding bill, a lot could happen to that bill between now and a week from tomorrow. I'll go to the next slide.
Yeah, well, I think that does raise the question of where do we've been hearing a lot about retirement legislation and, some positives with regard to that. But is there, what's the likelihood that this is one of the tax provisions that could be added into either to the omnibus or even to the defense authorization?
Yeah, originally, so there's a term called Secure 2.0. So Congress was enacted into law, and I believe in 2019 was the Secure Act, which basically provided retirement provisions, so to speak, tax provisions. There's now a Secure 2.0, and so what they're trying to do now is to figure out, hey, can we get this on any other bill? And so it looks like if it gets added to any sort of legislation, it's going to be on the omnibus spending bill and not the NDAA, the defense authorization bill. But we literally are just trying to wait and see. The Secure 2.0 has a lot of support in both parties and in both chambers of Congress. And so I'm going to say 2 months ago, it was wholly expected to actually be passed this year. Something happened throughout the last couple of months, and maybe lawmakers quit focusing on it, but it kind of got into the world of, is it going to pass or is it not? Now, the reason why it's even being thought about is because, like I said, every lawmaker likes this bill. I mean, just about. It passed, the Secure 2.0 passed the Ways and Means Committee by voice vote. What that means is that there was no dissension for this bill at all. It went to the floor and passed by a large bipartisan measure. So that is a really good sign. The other thing too is a lot of lawmakers who actually worked on this bill are retiring. So there is some sort of impetus of like, you guys really worked hard to get this bill. Maybe we should pass it because you guys are retiring. So they would retire while passing the retirement bill. How cute. Anyway, the problem with that, or we can go back to the last slide.
Oh, sure thing.
Yeah. So the House has passed a retirement bill, Secure 2.0. The Senate has not passed its retirement bill. Currently, there are two Senate committees, the Health Committee, the Health, Education, Labor and Pension Committee, and the Senate Finance Committee. They have passed their own respective retirement bills. So, and they differ from what passed the House. Now we can go to the next slide, if you don't mind. And so what has to happen now, and what's supposedly happening behind closed doors, is that there's no committee action on these bills currently in the Senate. Part of the reason for that is because there's just no time. So what's happened is that it seems that leadership has actually taken a role to say, well, what should these bills look like? And that's what we're going to pass. Now, some lawmakers are basically saying that Secure 2.0, the legislation that passed the House, will be the legislation that gets into a bill that passes Congress if a bill on retirement gets into a spending bill that passes Congress. So there's a lot of ifs and a lot of unknowns here, because what leadership could basically do is take what passed the Senate Finance Committee, take what passed the House, and take what passed the Senate Health and Education and Labor and Pension Committee and do what they want with it. And this is not what we call regular order, where something goes to committee and then it goes to the floor as it was written in committee, and then it gets approved. What we're doing with here is that leadership is basically trying to just figure out if pieces of the retirement bill can pass both chambers, what they are, and then put that in the bill. So we might have a piece of the Senate Rise and Shine Act be a part of Secure 2.0. So we don't know that yet. We just don't know what's going to exactly happen. Do we move forward?
Well, yeah, why don't we take a look, although it is, as you point out, there are differences in really what are 3 separate pieces of legislation. There are some common themes, though, that we see in the various pieces of legislation, and there are differences in the details. So we're not going to try and guess how that comes out, but I think it is worthwhile focusing on some of at least the common ideas that are included in all pieces of the legislation. Now, as always, some of these provisions could be dropped. New provisions are likely to emerge, particularly if we don't make it this year, and this is something that carries over to the future. But I think this is a list of the items that we're do really seem to be moving in the same direction, both on a bipartisan basis and also on a bicameral House and Senate basis. And we can just quickly run through some of these are pretty self-descriptive, but the idea that hardship you have to meet hardship requirements for early withdrawals from pension plans in order not to be subject to a penalty. Currently, employers are required to certify that, some sort of self-certification, that so long as the employer does not actually know that the certification that the employee provides is inaccurate. Again, a lot of the goal here is to replace the burden and also to incentivize more and more activity in the retirement area. So, for instance, we do now have automatic enrollment percentages with regard to things such as 401k plans that are participated in. Now, an employee can elect out, but if they don't elect out, then they are automatically enrolled at a set percentage. The legislation, although the new rate differs, would actually be looking at increasing that enrollment percentage. And to further kind of boost the idea of developing, particularly on the small employer side, the legislation has proposed a series of new small business incentives. And in this case, small business may really mean small business, probably somewhere in the 25 to 100 employee category, but would increase the amount of startup costs that can be claimed as a credit. And I think also importantly, would make the participation in a multi-employer plan, or what they call a pooled employer plan, available for claiming these credits. The pooled employer plan, it was a feature that was included in the earlier secure legislation, the provision that passed back in 2019, was designed to greatly facilitate the ability of primarily smaller employers to join together with completely unrelated employers in effectively sort of a master plan, with the goal of hopefully significantly reducing the cost of at least setting up the 401k and also managing the 401k. To date, I don't believe that as many businesses have taken the Congress up on that idea as was hoped. And this may be a part of trying to kickstart that area. So you may be, particularly if you are engaged, and this can apply to existing plans as well as new startup plans, you may be seeing in the coming year some additional attempts particularly if this legislation is to ultimately be enacted, some additional opportunities to engage and participate in those pooled employee plans. The big item is the required minimum distribution age. Right now, we're at 72. So, for instance, if you have a Kia, if you have KEO, IRA, whatever, you have to start taking distributions at age 72. All of the legislative packages so far increase that age ultimately to 75. Now, there are differences as to how quickly we would get from 72 to 75. And in fact, there are differences with respect to effective dates throughout this. I would not anticipate any of these provisions being effective prior to 2024. That seems to be the basis. A lot of the Senate provisions were set up, or the Senate legislation that came out of the committees was set up to only begin in 2024. And the expectation is, particularly because some of this requires some time to implement, then there are other things that could be there. Speaking of required minimum distributions, the idea of reducing the penalty. Right now, if you fail to take your required distribution, there's a 50% penalty. And the idea, there does seem to be a general agreement that ultimately we're going to reduce that from 50% to 25%. And in fact, in one of the Senate bills, there's even a provision that would reduce that further to 10% if the money is promptly, they say promptly returned. We don't know what promptly returned means, just like we don't know a lot of the details here, but it is, I think, really a step forward to saying, you know, sometimes failure to take the required distribution is an error. It is not a device. And so the 50% penalty was really too penal, if you will. One item that is also worth paying attention to, the earlier Secure 1.0 included a provision that required part-time employees to be included in pension plans if they've had 1,000+ hours for 3 consecutive years. The legislation is at least going to be looking at reducing that 3 down to 2, and there does seem to be bipartisan support for that. So that again is an item that may be worthwhile looking into. With that, now that's that's sort of some of the details that we at least have been able to discern with regard to the legislation.
So Mel, can I interrupt for a second? Yeah. So audience, what Mel just went through is pretty much what the lawmakers are going to hear in the same amount of time when they vote for that bill. So seriously, like what Mel just did is when they bring the caucus in, they're going to have the staffer stand up there with a point and go, this is in the bill. Mel might have provided you more information than the lawmakers going to have before they vote on this, if it gets into a bill. So anyway, I just wanted to share that because I used to work on Capitol Hill, and the complaint was always, we don't know what we're voting for. So basically, you guys might know more than the lawmakers if this bill does get into a bill. Anyway, I digress.
Yeah, well, no, I think that's an excellent point. And okay, so we don't know. Secure could be 2.0 could be included, might not be included. What about some of the other tax provisions that people have been talking about?
Oh boy! All right, we've got there's a lot here to cover. Big question mark on this is, I'll explain later. Let's just go with what the biggest business provisions are, and what these 3 provisions that you see on the screen have support from members of both political parties in both chambers of Congress. And so what they basically want to do is right now R&D started at the beginning of this year. You have to amortize it for 5 years. They would like to actually get rid of that amortization and allow R&D to be expensed again. For the 163J interest deduction, basically what they want to do is broaden it to where currently you have earnings before interest and taxes that affect your interest deduction. They want to broaden that to include depreciation and amortization, which is what it was prior to the Tax Cut and Jobs Act. The other thing is bonus depreciation. Next year, it goes to 80% instead of 100%. And then from there, it goes down 20% every year until 2027, it's 0%. And so what they want to do is get rid of all of that reduction and just make 100% bonus depreciation happening forever. Now, again, I'm sorry, go ahead, Mel.
Nah, I mean, all this sounds good. And is this a partisan thing right now, or are these three provisions being opposed? And if so, why?
So what the deal is these provisions are not being opposed, except they need to add something. And bada bing, Mel, that was perfect timing. Welcome to the child tax credit, folks. So what's going on here is that you have lawmakers in both parties who support the business provisions we just showed you. There's only one party that supports modifying the child tax credit. And what happens is that in one of the past bills, the child tax credit was expanded greatly. It went from $3,000 a year for kids 6 to 17 and $3,600 a year for kids under 6, and it was fully refundable, which I'm sure everyone here knows what that means. But if you don't, basically, if you had no tax liability, you wouldn't be able to get the credit. But if it's refundable, you can get the credit, which means the government sends you a check. So you can have zero tax liability and still get $3,000 or $3,600. It reverted back at the beginning of this year to what it was under the 2017 tax reform bill, which is $2,000 credit for kids under 16, and only a portion of that was refundable, which was up to $1,500. So what one party wants to do is bring back the big one, the refundable, the big payout. The other party doesn't want to do that, and I'll go into why. But basically what happened is that the people that are supporting the business tax provisions will oppose those business tax provisions if the child tax credit is not included in legislation that modifies the business tax provisions. And the reason why the argument is so fraught is because of this slide here. The child tax credit, the full ask of the child tax credit is over $1 trillion over 10 years. And so the argument has become, well, if we're going to do the child tax credit for $1 trillion, we should also do business tax breaks for $1 trillion, because one side should get not a bigger tax break than the other side. Well, that would be a $2 trillion bill for two provisions. This is not going to happen. And so what they're trying to do now is narrow the provisions. So I was on a call with the lawmaker staffer, and this staffer is pushing for the child tax credit to be included in legislation. And I asked, so it's $1 trillion ask, and the staffer said, no, it's not. We've asked for a more narrow definition of the child tax credit is what we want, and it'll be way less. And I asked, what is your ask? What is the ask that you're asking for? And the staffer said, I can't tell you. We're going to keep it a secret until all the lawmakers agree with it. Well, in Congress, there really isn't anything about people holding back secrets or anything. So also too, the staffer then asked me and a group I was with to lobby for the child tax credit that she refused to explain to us. So the conversation cannot be going well if they are going to lawmakers saying, hey, support the child tax credit. And they say, oh, what's your proposal? And they say, we can't tell you. That it just is beyond logic why they would even try to do that. So the problem we have here, the bottom line to this slide is Congress is not going to pass a $2 trillion tax bill that only includes 2 provisions. And so the narrowing that's supposed to be happening is actually happening, but there's still no agreement on the child tax credit being added. We can go to the next slide if you want, Mel.
All right. Well, that brings us to, we don't know what's going to happen. What do we do if the tax bills don't pass this year? Are these both Secure 2.0 and these business provisions, and I guess for that matter, the child tax credit, do they just move to the next year's agenda?
Nope. Here's why. So what we have, okay, Congress, there are Congresses. So we are in the 117th Congress. Congress's last 2 years. So a person can introduce a bill at the beginning of the Congress, and it's active for the entire Congress that Congress is active. On January 3rd, we begin a new Congress. And you always know when a new Congress begins because the elections happen and in November, and you know that the next January, there's going to be a new Congress because we just voted for new lawmakers. And so that basically means every single bill that was ever introduced in the current Congress has to be reintroduced in the next Congress. And one question that's outstanding is Secure 2.0 had a lot of lawmakers on it that are now retiring. They won't be in Congress next January. So will Secure 2.0 have the same oomph, or will it pass before the end of the year? So the other thing to look at is the political dynamic in Congress is going to change. What we're going to have come January 3rd is we're going to have a split Congress. One party's going to control the House. One party's going to control the Senate. And the party that controls the Senate also has control of the White House. So what does that mean? If a lot of people are saying it means that no tax bill is going to get through. That's a very easy thing to say, but it may not be true. The reason why is because there are a lot of economists basically suggesting that we might see a recession next year or the year after. And the question of how deep and how severe the recession will be is highly questionable. Now, walk with me back to 2010. This is exactly the situation we were facing in 2010 when the Bush tax cuts were about to expire. And a lot of people ran for Congress and the White House in 2008 and said, we are not going to allow the Bush tax cuts to be extended. We're going to let them expire because they only serve the wealthy. There was a caveat in there that the Bush tax cuts for the middle class should be extended. So what you had in 2008 were both political parties basically saying the same thing, except for the rich. And so both political parties were okay with extending the Bush tax cuts for the middle class and below. Well, 2008, I'm sure you all remember, we had a really, really bad recession. It was nearly a depression. And we were climbing out of it in 2010. And one of the issues was if the tax cuts go away, if the Bush tax cuts go away, we might fall back into recession, or it'll actually slow recovery. And so what a Democratic president did and a Democratic Congress did was extend a Republican tax cuts. They extended them all for 2 years. So when you look at what's happening now, there's a similar situation almost happening to where both political parties agree that the middle class tax cuts should be extended, but only the wealthier tax cuts should go away. We also could be facing a recession and might need some sort of impetus to get out of it. And basically allowing tax cuts to be extended is a way that actually helps people. Economists might disagree with that, but this is what the political world thinks. So what we might see is a total redo of what happened in 2010. And when will we see that? I don't know. But it's something that it's not exactly true that no tax bill will pass Congress because the parties are split on who controls the chamber.
Well, Jay, let's assume that we do have, again, I guess we're sort of assuming that we don't make it. These pieces of the tax legislation don't make it here this year during the lame duck session,
right?
And have to be restarted in 2023. Can give us a little bit of a sense of what the process of that is going to be?
It's fraught. Okay, you have two ways to do this, and there's the regular order way and the way things have been usually going. And so I'll be quick about the way things are usually going. Leadership designs the bills, and then they force the lawmakers to pass it. That's what's basically happened. Regular order is a bill gets introduced, it has a hearing in committee, has a markup in committee, it goes to a floor, gets voted on and passed, then goes to the other chamber where a committee has a hearing on it, a committee has a markup on it, it passes, it goes to the floor, it passes, and then they combine those two bills to figure out if there's any differences, and then they work out those differences, and then it passes both chambers again, and then it goes to the president and he signs it into law. So if we're doing the regular order route, we're not going to be looking at a tax bill in January. The reason for that is because there's the chairman, the House Speaker has yet to be decided upon, and so that means the chairman of committees haven't been decided upon, and that also means that if there's new members to the committee, those have also not been discussed or decided on. And so what we have here is basically, according to people that know this better than I do, the soonest that a bill could actually be produced out of the House could be March. And so at that point, you're looking at first quarter. And so one of the questions becomes, well, if we're going to do R&D and we're going to expense it, do we expense it for 2022 since it's already happened? And also, too, if we don't expense it for 2022, that means it's less money, so we can do other things. And so there's a lot of questions, and the same thing with the child tax credit. If that passes the House, if a tax bill passes the House next year in March, for argument's sake, it will not include a child tax credit modification at all. So the question becomes, so once a bill, let's say the bill passes the House, goes to the Senate, which is controlled by the other party, Democrats, they can do whatever they want to with that bill. So they could add a child tax credit to the bill and then force it to go back to the House. So what the House can then do is then say, no, we're not going to do this. Well, things happen to where sometimes people agree with stuff. And so what you might have here is you might have House Republicans facing a Democratic bill with a child tax credit and starting to wonder, is this worth the fight? And so maybe we should just agree to this and then focus on the provisions that we liked and let them talk about the other provisions. Because at some point it does get to an area where you're like, are you going to help the American people or not? Like, how much of an argument are you going to have here? Everyone was asking for child tax credit and R&D expensing January of 2022. You guys didn't do anything. Now it could be springtime of 2023, and you guys still aren't doing something. So at some point, there might be a shift. I don't know exactly how, but you might actually see where the child tax credit does happen. But it will not start in the House. It will start in the Senate for next year.
Okay, well, that is gives us a sense there. Hold on, here we go. And I guess this kind of sums up again what this slide sums up what you were talking about, that it is going to take a while to ramp everything up, and we'll have to see how that develops. I mean, I can almost, what do you think if it makes it out in March? Could the Senate move quickly enough that we could see legislation, say by Labor Day, or is this something we're going to be waiting for Luke missing our Christmas vacation in 2023 waiting for?
Well, the issue is that the lawmakers who support the child tax credit have really publicly supported the child tax credit. Now, I can tell you that there's a lot of people that supported getting rid of the SALT cap, and they voted for the bill that didn't get rid of the SALT cap. So it's really unclear exactly how, like, what this bill will actually go through, because you would think that at some point they're just going to have to say, okay, we have to pass this or do nothing, and they're not going to want to do nothing. And so I think that what could really happen is you're going to see a shift either to one side or the other that allows things to happen. And that's kind of what goes on. It's that something happens in the economy, something happens in the news, and suddenly people are wondering, wow, should we be doing something about this? One example of that, which is not tax related, but the power outage in North Carolina recently has started people really saying, hey, maybe we should worry about our grid a little more than we do right now. And those conversations are happening in Congress. And those conversations weren't happening in Congress before the North Carolina power outages started. So their shifts happen, and then we can see what goes on from there. But it's going to be a dogfight with the child tax credit. I'll tell you that for sure. And I don't know who's going to win it, but we'll just have to wait and see.
Well, I think that's fair enough, and it's I think worrisome that the fight is perhaps holding up some things that really are business changes that certainly make a lot of sense and would make life a lot easier, particularly for those of us who may have to be involved in filling out the forms and going back and recreating that R&D amount.
Yeah. Also, too, the business provisions that we're talking about, they were never supposed to be enacted. The thought was that they were passed in a past bill. They were approved in a past bill so far ago that people thought, surely we'll figure this out before we get to that deadline. Well, no, we got to that deadline and they all happened. So these provisions were never supposed to happen. And I was in the room when this conversation was going on. And so, yes, we were told these provisions will never happen. And most of us laughed at it. And here we are.
It's not the first time this has happened. We'll get to that
not the first time.
In a minute. Let's spend a minute and talk about what some of the others, and of course, as we've mentioned, changes. Will we be retroactive to 2022? There are a number of, although a lot of the, particularly the clean energy related items that had expiration dates were dealt with in the Inflation Reduction Act, and the very significant part of the Inflation Reduction Act that dealt with clean energy. There are extenders that just got left on the deck, and a couple of them that I think actually may affect individuals, may affect some businesses, is the ability to claim an itemized deduction for mortgage insurance. That went away after 2021. Can they reach back that far? Unclear, as with the changes in, well, certainly with the increase in home prices, with the, now it appears going to be increase in mortgage rates that are going to be with us for a while, the need to have such things as mortgage insurance may be increasing. And if that is the case, we may well see this bubble back up. Whether they could go back all the way to 2021 or 2022, we don't know. But of more immediate is the deductibility of business meals, which was expanded from 50% to 100%. That rotates back to 50% after the ball drops in Times Square this New Year's. So that is another one. And I think it's fair to say that the restaurant industry is still struggling. And that maybe this is one area, although we don't really expect the incentives, the relief provisions that we saw during the COVID era being renewed. This is perhaps one that would have a greater chance. But as Jay has said, there are a number of things in the TCJA, not only that were added with the estate, with the assumption that they would never actually come to be, but have a specific expiration date. And virtually all of these are really on the individual side. And so it gets into questions of, well, who takes advantage of this? What is the, what's on, and some of these are going to be relatively expensive to deal with. But the corporate income tax rate was permanently reset. The individual income tax rate was not. Yep. And so sometime between now and I guess 2026, there is going to have to be a reckoning. Jay refers back to the reckoning that we had in 2010, where suddenly the no, we'll let it expire became, well, we'll extend it for a little while longer. But it is there's some significant provisions here. And on the business side, the 199A, the pass-through deduction, that's a very material item for a lot of businesses. I think we are already seeing some very, very active lobbying in connection with this that will potentially move it forward. And I would not be surprised to see that become one of the major issues. Now, the temptation, and Congress does not have a history of dealing with things before they absolutely have to, and sometimes even a little later than that. But this is one I think that we will be seeing on the radar going forward.
Now, can I add something here?
You bet.
So what's going on right now is the Inflation Reduction Act extended energy provisions for a full 10 years. And the reason for that was to give people certainty that you could do this. Now, before that bill, basically these things were extended 1 year at a time, a year too late. So I can't even take advantage of it, kind of thing. The argument that's going to be used now, that's actually being used now, when you look at 199 Cap A, what they're saying is backers of extending 199 Cap A are saying, you guys gave certainty to the energy provisions. Why can't we give certainty to the business owner? And what you just did with the Inflation Reduction Act, we should be doing with 199 Cap A, with the individual rates. And so they're basically saying what you all did for energy, do for everybody else. And so this argument has already started, but it's going to continue more so in 2023 and 2024 with the hope of actually extending these provisions before the end of 2025. Now that's a really huge lift, but the argument that they're making is if it's good for one, why not the other? And so let's do it all again and give certainty not just to the energy sector, but to all businesses. And we'll just see how that argument lands.
Okay, yeah, very much so. And going beyond the question of things that were supposed to expire, things that did expire, things that might expire, we did have a very significant piece of legislation in the Inflation Reduction Act. And although not all the provisions affect everyone, they are ones that perhaps were not fully worked through. All the details were not fully worked through. And it's always, I think, very iffy of a question of whether or not corrections to recently enacted legislation can pass. Certainly, I think as people try and implement certain provisions that were in the Inflation Reduction Act, we're going to see feedback of either A, how difficult it is to match up, or perhaps things will be identified that just flat don't work. Now, there has unfortunately become, I think, something of a tendency in Congress to say, if one party enacted something pretty much on their own, then the other party says, well, don't look to us to help you fix it. And we can see that going back to Obamacare, where I think that there were a lot of things that probably should have been fixed in Obamacare that were not, because there could not develop the kind of bipartisan approach to address those. Similarly, I think we see a threat that Jay's pointed out with regard to the TCJA provisions, the Republican provisions from 2017, where the Democrats said, well, you guys created it. Don't look to us to fix it for you. And that could easily be, we hope not, but that could easily be the same response that we see here. So let's not assume that any of these will necessarily be picked up. But three things I think that are worth noting. The corporate AMT provision, and you have to have $1 billion in order to be subject to the corporate AMT. So this is a limited group of taxpayers, almost all of whom are heavily involved in international activities. The way that the legislation interacts in the international area is obscure, I will simply say. And I think that probably is one that some additional details are going to have to be worked out. One of the major provisions in the IRA legislation was the additional $80 billion for the Internal Revenue Service. And I think that is one area that we know is likely to be certainly under inspection in the House, and at a minimum could lead to a reordering or a reallocation of where the money goes, because in the IRA legislation, there was a specific amount that was to go to enforcement. There was a specific amount that was going to go to client relations. There was a specific amount that was going to go to technology improvement, which, get away from the idea that we're keeping records on these things that you see spinning around in the early 60s movies of computers. That is something that I think, and it may well be that just a cutback of the numbers would be there. So one thing I think to keep in mind, that is something that may well be fluid. And finally, with respect to the clean energy incentives, almost all of the clean energy incentives that were included in the IRA ultimately require a prevailing wage and apprenticeship standard to be met in order to take advantage of the full amount of the credit. Now, that was copied. The rules it appears to be that the rules are being copied almost entirely from the Davis-Bacon rules that apply to construction of federal facilities. So they are very focused on a situation where you probably do have a labor union involved, and you are probably dealing with a very large construction project. If we take those prevailing wage and apprenticeship requirements, which really were designed for large operations, and now try and impose them on any company that wants to come and install a solar panel, it is by no means clear that it is going to be practical for those to be met. And while there is great hope that perhaps the Internal Revenue Service will find a way to say, okay, here's a safe harbor that you can use, or here is a way to clean this up, or if you're only a certain size, then you can do it this way, and you don't have to file a full Davis-Bacon report. I've got to say, though, I listened in to a webcast that was provided by the Department of Labor yesterday. I think they're repeating it right now as we're on, and they gave no indication at all that there is any relief from the standards that currently have to be met under Davis-Bacon for the building of a 40-story office building for the federal government. In the case of a small contractor that's installing solar panels, maybe is installing a small windmill on real property. So things that are going to need to be at least to be looked at, and may require more than just a nudge, but some actual changes from Congress if they're going to work right. The idea that the party that pushed through the Inflation Reduction Act with regard to clean energy incentives was not only was the country going to move to green energy, but also the country was going to create good, high-paying green energy jobs. And they slapped both of them together. And we're now, I think, running a concern. At least we're hearing from many of our clients a concern that by putting the two together the way they were put together, we're not going to get either. And that is something which I think certainly we're going to, I'm at least looking for some changes with regard to that. Now, there is a big question here with regard to legislation, because there's a piece of, we talked about there being must-pass legislation this year. There's some real must-pass legislation next year that may or may not have a significant effect on the tax situation. And Jay, I think I'm going to turn it back to you to talk a little bit about this one.
So the debt ceiling. So this is a product of, I believe it happened after World War I, where basically the federal government said, you know what, we should basically stop how much debt we can issue by creating a ceiling. So we say the debt ceiling is $1, we can only issue bonds for $1. And we can't go beyond that $1 until we raise the debt ceiling. So that happened, and we still have it. And so the debt ceiling now is expected to be raised in the fall of next year. It's unclear to me if that is, there are things they can do to basically extend the debt ceiling after we hit the limit. And that's basically not pay all of our bills that we owe to ourselves. And so, but what's being talked about now is anything we add to a debt ceiling bill that basically extends the debt ceiling will become law, because the debt ceiling has to be raised. So there's a lot of questions on, well, what can we add to the bill that wouldn't normally pass, but has to pass? And the question becomes IRS funding, the $80 billion that Mel just talked about. Many of the Republicans in the House and the Senate think that the IRS should not get that funding. So do you put it on the debt ceiling bill, a provision that rescinds the IRS funding? Do you add a bunch of tax legislation? If we don't have the R&D yet, do we add that on there? And so a lot of the hangover issues that we have, and the ones that we're looking to basically fix ahead of time, like 199 Cap A, do we add these things on to the debt ceiling, allow it to pass the House, and then bring it to the Senate and say, look, if you guys don't do this, we're going to default on our loans. The federal government will be in default. That's not what anybody wants. And so the question becomes, will one party agree to that, even though they don't like what's on there? Because if they take it all off, it has to go back to the House. So if the Senate takes off all those provisions and brings it back to the House can just add them back on, and then we have a ping pong situation going back and forth. And the question becomes of will. And so the will might be that the president would say, I will not sign that bill into law that has all these provisions in it that I don't like. But if he does that, is he the president that's going to default on the debt? And so that's a question we don't know. But this fight is expected to be a big one. And if there's any sort of outstanding tax issues that haven't happened yet, chances are it's going to ride on this bill, at least through the House. And when it gets to the Senate, we'll see if they accept it, or will they understand, do we really have an option here, or should we just let this go? Also, too, if the debt ceiling bite's happening while we're in a recession or in some sort of teetering toward a recession, will people really be against extending tax cuts? I don't know, but that could be part of the problem, or part of the debate. And so the debt ceiling is going to be a big issue. And when they begin to debate it is unclear, but they have to do something by at least third quarter of 2023.
Okay. Well, thank you, Jay. I want to thank everybody for staying with us for the hour. I think Jay and I, in some ways, had kind of hoped that we would have something more final to tell you, but so far we wait, Congress. So, and certainly if anyone has questions, anyone wants an update, please feel free to email is really, I think, probably the best way to reach either Jay or I. We are always happy to try and get back to your questions. Probably best that you email both of us so that one of us can get to you. Certainly, if anyone is interested in joining Mel's Army for a reasonable wage requirements, please let me know, because I think that's going to be it's certainly one that tickles me, and I think it's going to be one that's going to be important to a lot of taxpayers particularly on the construction side of the package. And again, everyone, thank you so much for joining us today.
Yes, thank you guys. Appreciate it.